Hi, and welcome to the Stock Scores Market Minutes for October 8th, 2018. All right, well, last week we had interest rates rise as bond prices fell, and that contributed to the sell-off that we saw in stocks. And so I thought this week I would just address why this happens, and there's a number of reasons why. We'll focus on the main ones. First of all, when there are rising rates of returns on bonds, it makes bonds more desirable as an investment. So people will move money out of stocks and into bonds where they're getting a higher return than they did before. Now, it doesn't necessarily mean that the return on stocks is less than the bonds, but it's just that in a process of adjusting a portfolio, if you can now get 3.2% rate of return on a bond or 2.9% rate of return on the yield from a stock, sometimes money will flow into the bond market. The other aspect is that it raises the cost of borrowing for companies, and that could lower profitability. Companies finance themselves with debt and equity, and that debt component gets more expensive as interest rates rise, bond prices fall. But I think one of the more important reasons that has really been important just in the last few years with really low interest rates is that companies have been buying back their stock by issuing debt. They issue debt at very low rates of interest, and they use that money to buy back their stock. And so if they had 100 million shares outstanding and they can buy back 5 million shares, now they only have 95 million shares outstanding, but for the same amount of company value. Now, certainly there is a little lower value with that debt on the books, but it's been a way for companies to really drive their stock price higher as the valuation of the company is spread out over fewer shares. And that real buyback programs that have been in place for many years now, since interest rates have been so low, has really contributed to the strength and stability of the stock market, because when there's weak days, the companies are still buying back their shares. All right, let's get into this week's analysis. First of all, let me just show you the chart here on the TLT, which demonstrates the drop in bond prices right there. And that's just the last 3 days of the week, which took bond yields above 3%. Okay, so when this goes down, interest rates go up, and that was the real reason why stocks sold off. And you see that when you look at the chart of the S&P 500, it really sold off those last 2 days anyway as bond prices broke down and interest rates rose. All right, let's get into this week's analysis, starting with the U.S. markets and, of course, with the S&P 500, the chart we just looked at. And what's important is that very short-term upward trend was broken on Thursday, and that contributed to the fairly sharp decline that occurred in the short term. Looking at the bigger picture, the long-term weekly chart, long-term upward trend is still well in place, but that shorter-term upward trend has been broken, and so it does look like we could see more weakness than what we have seen so far. It's not a major breakdown in the sense that on the weekly chart we're not really coming off of a falling top like we saw back there, but there was a falling top on the daily chart, and that's why I think it's not unreasonable to expect more weakness near term. Looking at the Russell 2000, and again the weekly chart, there is your long-term weekly trend line, and we've retraced back to that trend line, which means we should bounce there, but it also means we could break that. So if we hold for a couple of weeks and then ultimately break down, you want to get real cautious with the small cap stocks in the US. Onto the Canadian markets, and looking at the TSX on the short-term time frame, the 30-day 60-minute chart, you can see that we've had that little downward price action. We are at some horizontal support where the market should bounce, but generally speaking, we've been sideways for the last month. Looking at that longer term chart, we have built a falling top, and that concerns me because if we do break through this support level, we could be headed down to this support level here. So I think some caution is warranted. Even though we don't really have strong selling pressure yet, things are not looking all that awesome on the Canadian market. On the TSX Venture, which of course is the microcap stocks in Canada, we're building a descending triangle after trying to break this long-term downward trend. We haven't really made a solid break of that downward trend, and if we break down through support here, we're going to come back and test that zone right there. On to currencies, of course the US dollar, the one we always focus on, and it had gone a little quiet for a few weeks, but the last 2 weeks we've seen a bounce back, and of course If interest rates are higher in the US, it makes bonds more attractive to buy. It means money comes into the US dollar to buy those bonds, and that's one of the reasons why the US dollar has jumped higher the last couple of weeks. It is not really through this resistance zone yet. We're sort of stuck in this sideways range, but the momentum is upward given that we have rising bottoms on the chart. Canadian dollar trying to break its downward trend, and of course with NAFTA going through, I thought maybe we'd see a little more strength in the Canadian dollar, but we really failed to break that downward trend line. It's not over yet. Certainly it could still do so. We do have some rising bottoms building, but the question is, do we sort of go sideways under that downward trend line and then ultimately break through, or do we roll over and continue lower? For now, I think you still need to be somewhat pessimistic on the Canadian dollar because it has not been able to break its downward trend line. And then of course the interest rate chart, this is where that rise in interest rates really shows up. There's that long-term support, and again this is a weekly chart going back 3 years, so this is fairly substantial support. Is held up for over 2 years, and last week it broke that, and that is a pretty strong signal that interest rates are rising. And therefore if you're thinking about borrowing money or locking in some debt, it may be time to go to a fixed rate as opposed to a variable rate. On to commodities, and here the price of gold never really fares well with the strong US dollar, but it actually held its own despite the strength in the US dollar. We are still in that sideways range, just I would say stabilizing, but by no means showing optimism yet. And so, maybe you could lean toward the neutral outlook for the price of gold, but it is still not a bullish outlook, and it probably more so bearish. If we break down through the support, then we're going to head down to that level pretty quickly. On oil, well, oil continues to surge higher, probably getting a little overextended to the upside. There's our upward trend line, and we really hit the top of that price channel last week, and you can see that it fell off from that top. Couldn't hold those gains at the top of the channel. It's simply a case of profit taking when you've had 6 to 8 weeks of solid runs higher in the price of oil. You get to the resistance level at the top of your price channel and some sellers come out of the woodwork, and that's what we've seen with oil. Upward trend still intact, just a little overbought short term. So my ratings then neutral on US stocks now. That breakdown last week is something of a concern, but not bearish yet. Canadian stocks neutral long term, but bearish short term. Gold remains bearish long term, but I've raised my rating to neutral short term as it is trying to stabilize. And oil bullish on both time frames, but a little overextended to the upside. US stocks were hit with some selling pressure this week, breaking that very short-term support and putting some doubt in the minds of the bulls. Good chance we bounce off of trendline support this week. It's certainly not a case of the end of the bull market, but something of a concern. Canadian stocks are building pessimism, and oil is strong but overextended to the upside. Gold stable, but still bearish long term. All right, let's take a look at the trade of the week, and this is a stock that really shows a great example of how humans get so emotional. This was the stock that came up on my worm strategy on the open there on Wednesday of last week, and it really did fantastic. And what I want you to see is how this stock went parabolic into the close. The reason it went parabolic, I'm guessing, is that there was a lot of people shorting the stock through the day, and then going into the close, they just weren't getting paid for their short, and they had to scramble to cover. This stock is a relatively low float stock, doesn't have a lot of shares available to trade. It traded, I think, 3 times its float on Wednesday. And so what you had is just this emotional or desperation need to buy the stock to cover shorts, and maybe people chasing strength and buying with emotion. Anytime I see a stock go parabolic into the close like that, I'm apt to sell it into the close because it typically won't hold those gains the next day because people get more rational and it comes back down to earth. And that's exactly what happened. The next day, it really came back down to earth, gapping down huge on the open and just continuing lower all through the day. The people that had to cover their shorts here probably hated to watch this because it felt pretty painful to see their outlook correct, just their timing wrong. But that is one of the issues when you are trying to short sell a low float stock. Well, that has been the Stock Scores Market Minutes for October 8th, 2018. Please click on the like button if you enjoyed the video, subscribe to the channel, and if you want to get email updates every time I upload a new video, click on the little alarm button on the Stock Scores YouTube channel. Most importantly, have a great week in the market and trade well.